There has been a lot of discussion recently about China falling silent for a few days and the potential impact on silver prices of that quiet period. We will so distinguish between hype and reality in this video. Additionally, you will leave with a clearer understanding of what to pay attention to and what to disregard. Monday, February 16th, New York time, is the current date. Additionally, since this narrative progresses quickly and I want the timing to be clearly clear, I would appreciate it if you could let me know what day and date you are viewing from. Just so I know you're here for the real job, please subscribe to the channel and leave a comment for future Ledger Anna if you appreciate calm statistics first breakdowns like this. Here is the assertion that is currently circulating. Western paper markets will use the limited liquidity to hammer silver and drive people away while China's markets are closed for the spring holiday. When physical demand returns, the whole situation recovers so forcefully that it becomes a short squeeze. It sounds dramatic. It sounds like a movie. However, that single plot line conceals two distinct questions. First, is China truly as closed as some claim when they refer to it as dark? Second, does an easy, predictable price smash followed by a guaranteed higher launch occur even if a significant portion of trading is offline? Because you wind up trading a rumor rather than fact if you answer those two questions incorrectly. Let's begin with what we can confirm. According to the stated holiday schedule, China's main futures market will be closed for the Spring Festival stretch. Trading will resume on Tuesday, February 24th. Therefore, a significant portion of onshore activity does indeed pause at a specific window. However, pausing is not the same as the world coming to a halt. The market for silver is worldwide. Price discovery continues even after a venue shuts. It moves. It moves. It continues to go via other contracts, different time zones, different desks, and a lot of unnoticed over-the-counter traffic. Today, most people overlook this twist. Additionally, U.S. markets are closed on this federal holiday. Because today is the type of day when fewer traders are at their screens across many continents, you really need to take into consideration both sides of the Pacific if you're trying to tell a tale about limited liquidity. That is important. And that raises another detail that people tend to overlook. People tend to react to stale screenshots like they're brand new findings during vacation weeks, since even the regular reporting cycle can change. For instance, the regulator's weekly positioning data has a specific publication schedule, and vacations may leave gaps that are filled with conjecture on social media. When someone confidently recounts what everyone is doing, you should consider whether they are examining current positioning or if they are simply repeating last week's tale in a louder voice. All right, now, since that's what attracts clicks, the viral version of this China shutdown story typically has a villain and a plot. However, markets can move without villains. All they require is disharmony. Even something as basic as too many individuals bending in the same direction during a low-vol session can cause imbalance because movements in either direction might be amplified by low participation. It can aggravate anxiety. It has the power to amplify greed. Additionally, it can amplify chance. That's why people enjoy sharing the confident, step-by-step playbook. You shouldn't take Friday smash, weekend fear, midweek bleed, and day 8 fake bottom as interchangeable calendars. There is no schedule. It's a theory. When beliefs collide with actual order flow. Before we continue, I want to zoom out and make a point that may seem uninteresting at first, but it's important to the entire game. The majority of what is referred to be paper manipulation is simply psychology plus liquidity plus positioning. There are instances when markets exhibit real malfeasance. It's accurate. However, a crowded trade hitting a thin time is typically the logical result of what appears to be a concerted effort. Silver is the quintessential example of it. It is not able to glide. It lunges. When it realizes it has to pay the rent, it creeps back inside after climbing the stairs and attempting to jump out the window. Therefore, the proper question to ask when watching silver during a holiday window is not, will they smash it? Finding the positioning's weak points and the narrative that consumers will tell themselves if the price reaches such levels is the appropriate question, because the chain reactions are triggered by that. Since the paper versus physical argument is the main force behind the most significant claims, let's now discuss it. They'll point to open interest and say, look at all those contracts, that's a few 100 million ounces of promises. They'll then say something like, the exchange has registered silver that's ready for delivery, and it's hovering around that psychologically important threshold, just under 100 million ounces in recent updates. They'll then jump to the conclusion that there isn't enough silver. The system must thus malfunction. It's a clear conclusion. Additionally, it isn't complete because open interest isn't a line of individuals ready to purchase metal with cash. Open interest is the total number of contracts that are still in effect, including spreads, arbitrage, hedgers, speculators, and positions that will be closed, rolled, netted, or offset long before anyone even considers delivery. Here's a more effective way to picture things. Consider a crowded airport. The quantity of tickets available for flights departing this month is comparable to open interest. The quantity of seats available on a particular plane type at a particular terminal under a particular set of regulations is comparable to registered inventory. You can make the airport appear to be crumbling every day of the week by comparing the number of tickets sold to the number of seats on a single aircraft. However, because the majority of travelers change flights, rebook, connect, cancel, or never plan to board that particular plane in the first place, the airport does not collapse. That is the nature of futures markets. One probable escape is delivery. This exit isn't the default one. Additionally, we can be even more precise because the terms registered and eligible have official definitions. According to the exchange's own rule wording, suitable metal is defined as metal that satisfies the contract specifications and is stored in a vault that has been approved but does not yet have a delivery warrant attached. Eligible metal that has a warrant issued and is prepared for delivery against a futures contract is registered. Therefore, when someone says registered is low, they are actually referring to the low quantity of metal that is currently sitting with warrants. Although that is a significant signal, it is not the same as the absence of metal. Because as incentives change, metal can shift between groups. Here's the other subtlety that is overlooked in the loud version of this argument. Trucks, pallets, and forklifts are likely to come to mind when you hear the phrase delivery. However, many exchange deliveries involve the transfer of warrants, warehouse receipts, and ownership documents from one party to another. Unless the next owner decides to remove them, the bars themselves remain in place. As a result, even with heavy deliveries, the vault totals hardly change. Additionally, you can see significant withdrawals along with minor deliveries. You're confusing signals if you don't know the difference between those. That's how you become mechanically incorrect, but emotionally certain. Does that imply that physical characteristics are irrelevant? No. Physicality is important, since that's the last restriction. Infinite contracts can be written, but infinitum bars cannot be shipped, and that's where a more nuanced perspective is needed. It is possible for the market to be fundamentally tight without imminent default. Both possibilities are possible. Take a look at how silver is actually utilized if you want new, non-Twitter context on why physical demand keeps appearing. Where silver goes in the actual economy is broken out in government mineral summaries, and the breakdown is surprisingly varied. A significant portion of solar energy, a large portion of electrical and electronics, and a significant portion of investment bars and coins during times of anxiety. To put this even more up to date, the most recent government summary states that while industrial use remained relatively stable due to slower growth in one chemical process and lighter loading of silver per solar panel, the demand for coins and bars increased last year. This was counterbalanced by the continued growth in consumer electronics, power grid, and automotive applications. The silver market can be summed up in that one line. Efficiency gains are genuine, but so is the expansion of all electrical systems. And this metal is important, according to more than just the U.S. For years, industry surveys have discussed the recurrent physical tightness, and when demand exceeds mine supply, the market relies on above-ground stockpiles to fill the void. I'm not implying that tomorrow will be a short squeeze, though. I'm arguing that explains why, despite severe dips, silver continues to find customers, because there is a constant dull industrial pull behind the trade noise. The fact that there are multiple stories behind silver demand makes that blend significant. There are many stories in it. Solar can get hotter when tech cycles cool down. Industrial can maintain a floor as investment demand declines. Demand for coins and bars may spike during periods of fear when industry stalls. There isn't just one lever, it's a dashboard. This explains why silver doesn't follow a tidy, dependable chart trend. It's time to include China once more. Onshore price discovery is more subdued during the holiday closure. It's accurate. However, it is not always the case that China is sleeping and that no one is purchasing real goods. Manufacturers continue to plan. Supply chains continue to engage in hedging. The counting of inventories continues. Additionally, there are still opportunities to source, trade, and obtain publicity through other channels in contemporary marketplaces, even when one venue is closed. Therefore, you are relying on simplification if your entire argument is that China closed means there is no demand. And traders are harmed by simplifications. What then is the actual danger during a window of closure? It's not magic. It is a reflex. There may be air pockets if the price begins to decline and there is little liquidity. Stop cascades are available. It is possible for headlines to seem louder than they are. Indeed, some analysts will always read every red candle as a sign that the bull market is over. However, this is the counter-argument that people detest hearing. The frightening descent isn't always a trap. It can occasionally be a risk of market repricing. Occasionally, longs are simply taking profits because they want to reset the move since it became too stretched. Silver can go from unstoppable to hopeless in a single month, as anyone who has observed it over the past few years knows. Indeed, the recent volatility of silver swings and the way that open interest in momentum might wane following a speculative increase were recently brought to light even by conventional market media. And take note of what that suggests. A layer of support that people may confuse for genuine demand may be removed if open interest begins to decline in a March as a result of large players rolling forward or closing holdings. In other words, while leveraged posture is being decreased, you can have a physically tight market and still witness a price crash. There is no conflict there. This is how the physical crowd traveling on multiple timelines differs from the futures crowd. Therefore, you need look beyond the headline number to determine whether a squeeze is developing. You keep an eye out for signs of stress in delivery notices, spreads, and holders' willingness to sell metal at current prices. That serves as a warning, but it doesn't end the long-term case. A squeezing narrative should not be interpreted as a promise. This is where things start to get interesting because, despite the fact that many people are yelling short squeeze, there is a more subdued trend that merits notice. Along with other industrial metals that are important for national supply chains, electronics, and grids, silver was included in the most recent U.S. key minerals list. And because people will hear criticism and instantly assume there is a conspiracy, I want to exercise caution here. This isn't a film. Such a classification does not imply immediate price resets, prohibitions, or confiscation. The government is explicitly recognizing supply chain risk for a metal that can influence incentives and is found in everything from circuits to energy infrastructure. Permitting can be shaped by it. It has the power to influence how initiatives are funded. It has the power to influence the political desire for homegrown manufacturing. Real context is when you see that silver is more than just a day trade. Additionally, that relates to a larger event occurring across commodities. The most prominent metal for electrification is undoubtedly copper. Furthermore, if new production doesn't scale up quickly enough, key research groups are warning about possible supply shortages over the next 10 or 2 years. In a film about silver, why am I bringing up copper? Demand pressure doesn't keep neatly inside one metal as grids grow, data centers proliferate, and electrification scales. The power is moved using copper. Silver is in charge of the relationships. They are not alternatives. In the same system, they are partners. Therefore, don't consider critical minerals language to be a singular occurrence. Consider it an indication that the market is starting to become policy relevant, and markets that are policy relevant often become jittery. Add to that the fundamental reality that silver is both rooted in industry and next to money. Jewelry boxes and vaults are the most common places for gold to reside. Silver is eaten, it's incorporated into stuff, it spreads. When demand increases, it is strangely difficult to swiftly turn on supply because the metal appears in 1,000 little spots. Indeed, the question of whether solar loadings per panel are decreasing as total solar deployment increases has been up for debate for a time. One side claims that if there is less silver per panel, demand pressure will lessen. Deployment expansion outpaces thrift, according to the other side. Usually, reality is messy. At the margin, thrift is helpful. But when deployment grows quickly enough, scale triumphs. Therefore, you should consider which segment and at what price when someone asserts that industrial demand is unstoppable. Additionally, you should inquire as to which section and what baseline are being compared when someone claims that demand is plummeting. All right, let's go on to the section that matters most to everyone. Without succumbing to the hype, what do you watch during this closure window? First, observe the actions rather than the predictions. Look for two indicators if the price drops significantly on limited liquidity. First, does the market remain strong, or do buyers enter the market quickly? Second, does volume enter with the move, or does volatility increase as volume decreases? These two factors indicate whether the market is making decisions or if it is being pushed around. Second, pay close attention to the premium conversation. The term premium is used as if it were a single, all-encompassing number. It's not. Product, location, and inventory conditions all affect premiums. You should therefore inquire as to where, on what product, and for how long after hearing that rates are skyrocketing. It's intriguing if there's a brief retail premium on little items, but wholesale tightness is not the same as that. It's a different animal if it's widespread, persistent, and dependent on the supply of enormous bars. Third, observe the results of China's reopening. The first headline, not the first hour. Watch the initial sessions. The way dips are bought, rather than how pumps soar, is frequently a good indicator of real pent-up demand. I want you to dwell with this cliffhanger for a moment. Why would anyone in a position of authority want silver to collapse just as it is starting to gain strategic recognition if the smash tail is accurate? That is the area that isn't perfectly aligned. Sometimes the most straightforward response is that there isn't a well-thought-out plan. It's simply unwinding positioning. Although saying that isn't as enjoyable, it's frequently more accurate. I can hear the pushback already. You're downplaying the physical disparity in the paper. No, I'm not. The mismatch isn't a single ratio, therefore I'm placing it in the appropriate frame. Inventory classifications, delivery intentions, and owners' propensity to alter metal from eligible to deliverable status when incentives change are all dynamically related. The complete supply is not registered. There is a reason why eligible exists. Additionally, because owners react to economics, qualified individuals can register as soon as incentives change. It's not limitless, though. It indicates that it's adaptable. The next issue is, how much does that flexibility cost? Under what stress and at what spread? Therefore, rather than treating open interest as a countdown clock, it is more prudent to monitor activity around delivery periods. Let's now discuss the viral narrative's other significant promise. The reckoning is in March. Delivery months are important. They draw attention, which is why they are important. They compel choices. They shorten time. Additionally, those occasions might amplify a market that is already tight. However, once more, the default conclusion is a leap. The majority of stress events are settled via price, spreads, cash settlement incentives, metal movement, metal reclassification, or position reorganization by major players. Markets are meant to be flexible. They are not readily broken. Additionally, you should base your approach on probability rather than certainty, even if you believe that this time is different. Here is a useful question for you to respond to in the comments section. Which do you believe poses a greater risk over the next weeks? A violent squeeze that traps individuals in the opposite direction, or a severe shakeout that scares them out? I want your honest opinion. There was another aspect of the competing story that I would like to discuss now. The notion that China has outlawed rehypothecation, enforced forced delivery, and cracked down on paper games. The more general notion that different venues have different delivery cultures and regulations contains a grain of truth. However, the internet enjoys taking that kernel and using it to construct a huge fantasy palace. The skeptic's alternative is presented here. Every contract does not immediately become a delivery demand, even if a venue raises the bar. Furthermore, this does not imply that Eastern markets are authentic and Western markets are fraudulent. They are various tools, and various tools draw various types of participants. Treat it like market structure instead of making it a morality play. Additionally, market structure is subject to quick changes, particularly when policies change. This leads us back to the designation of key minerals, which provides insight into the path of U.S. policy. It also rhymes with a more general concept. Supply networks are increasingly being used as a national strategy. It's not just silver either. It has to do with copper. It has to do with grid metals. It concerns the inputs that enable electricity. Additionally, volatility tends to increase rather than decrease when governments begin to treat inputs like strategy. This is important, so let's perform one more fact versus fiction check. People sometimes remark that there are 3 promises for every ounce if the registered inventory is less than 100 million ounces and the paper promises are several hundred million. Squeeze next week doesn't follow even when that ratio appears to be approximately accurate on paper. because markets are flows and ratios are snapshots. Spreads, contracts, hedgers, and inventory all shift. Furthermore, the static ratio is not crucial. It's the course of action. Is the registered trend steadily declining? Are there more deliveries? Are spreads acting strangely? Are leasing prices on the rise? Do contracts in the vicinity behave differently than those in deferred months? Stress first manifests there rather than in a meme ratio. All right. Every story has the potential to become a once-in-a-lifetime experience, as anyone who has been following this place for a while knows. That is true sometimes. It isn't most of the time. It's usually a chapter rather than the conclusion. The loudest people are typically the least accurate, which is why I want to keep you grounded, even if things grow noisy over the course of the next week. And the key to success is accuracy. Before we conclude the market section, I would like to share with you a quick retention strategy you can employ when prices start to fluctuate. Would I be eager to start working here, or would I prefer to wait for better pricing if I didn't currently have a position? Ego is eliminated by that one question. Instead of identification, it transforms the screen back into information. If you're successful, tell others about it in the comments section to keep them inspired. Okay, let's have a brief sponsor break before returning to the potential course of this week and how to approach it. Because it combines two items that consumers often have to purchase individually, today's sponsor is a U.S.-listed gold exploration and development firm that has drawn the attention of many investors. The first is a collection of resource stage projects located throughout the Americas. 2. Sizable equity holdings in other publicly traded mining firms that may generate further profits when the market heats up. I am referring about Gold Mining Inc., which is listed on the stock exchange as GLDG. This part is sponsored, just so you know, and sponsorships help keep the lights on. With a portfolio of projects spread across the Americas, Gold Mining Inc. also owns equity shares in other publicly traded miners, which can provide flexibility when the market is booming. It isn't safe because of that. Small-cap miners can move quickly, cycles are harsh, and exploration is dangerous. Read the public filings, learn about jurisdiction risk and dilution, and then make your own judgment if you're interested. I will tell you what I look for in these kinds of businesses, but I'm not here to recommend anything. First and foremost, I want to see a concise list of essential assets that management is genuinely developing, rather than a haphazard grab-a-grab. Second, I want alignment. That is, insiders have more than just a title. They have actual stakes in the outcome. And third, I want openness. If a business claims to have resources, I want that to be supported by publicly available documents and technical studies that you may review. Fourth, if gold continues to rise, I want a structure that can profit from it without collapsing if the industry slows down. The combination of GLDG's own project pipeline and outside equity investments, which can serve as an internal basket of options, is what sets it apart. Institutions prefer to appear when they believe the cycle has turned, so certainly you will see names from institutions involved in this area. Therefore, spend 5 minutes reading the company's project summaries and public disclosures if you're interested in learning more. After completing your own research, determine whether it aligns with your risk tolerance. Let's go back to silver. This is the aspect that people tend to underestimate. The true question is not whether it was manipulated if there is a significant decline during this vacation period. What happens to the market following the downturn is the true question, since it's the tell. Markets that are doing well absorb dips. Dips turn into trends in weak markets. Silver has the ability to switch between those two identities more quickly than nearly anything else. Without assuming we can accurately anticipate the candle, let's map two conceivable routes. On the first path, there is a sell-off in thin liquidity. It's frightening. When headlines become unappealing, buying quickly follows, either because traders perceive value, because physical demand increases, or because short-term positioning becomes too lopsided and reverts. In real time, such kind of maneuver appears to be anarchy, but in retrospect, it's simply a reset. Option 2. A sell-off occurs, but the price remains high rather than rising. It may chop sideways. It may grind lower. This typically indicates that the market is processing a more significant event, such as a growth fear, a stronger dollar, more stringent financial restrictions, or just the fallout from a speculative blow-off. And if that's the route, the squeezing story is postponed rather than ruined. Later on, it becomes a tale. The cliffhanger is about to happen. This week's volatility may be more about repositioning ahead of the decision window than it is about disrupting the system if March is really a focus point. Large players do that. The headline is not what they wait for. Before the crowd knows the calendar matters, they make the necessary adjustments. What should you do with that knowledge then? A grandiose plan is not necessary. You must have a risk strategy. Define your invalidation if you are trading. Establish your time horizon if you're investing. Recognize that spot price and retail pricing are related yet distinct when it comes to physical stacking, particularly during stressful situations. Additionally, avoid using someone else's adrenaline as a tactic. This is where folks start to lose the plot, so allow me to add one more thing. It's quite easy to anchor on the lowest print you see and convince yourself that must be the bottom if the market does collapse during a vacation window. You get cut that way. Letting the market do its own thing is a superior strategy. Does selling pressure become weaker each time it shows up? Do rebounds become more powerful? Do purchasers intervene sooner? The market is displaying the power balance there. The market is signaling you it wants lower prices before it resets. If, on the contrary, every bounce is sold and the lows are consistently tagged, neither message is intimate. It's only data. The major suspense leading up to the reopen is now straightforward. Do we observe instant appetite or hesitancy when China returns on the lights? Because hesitancy would indicate that the speculative crowd may currently be more vocal than the actual crowd. The question then becomes whether appetite manifests as a one-day jump or as enduring bid support that prevents the market from moving lower. That's the clue that distinguishes a regime change from a headline pop. Since it reveals your thought process, I would want to ask you one more question for the comments. Do you think the market is manipulated when silver moves against you, or do you think it's crowded and then hunt for evidence? I'm not passing judgment. I'm simply curious about the attitude you're bringing to the screen. Okay, let's wrap up with a clear, useful checklist for the remainder. The market will choose the reopening date. So first, record it on your own calendar. Second, pay attention to how the price reacts to negative news rather than just the headlines. Third, monitor inventory updates, but pay more attention to trends than one-day printing. Fourth, consider the policy context because a metal's strategic importance can alter the flow of capital. 5. A well-known story is not the same as a validated mechanism. Please subscribe if this was helpful so you don't miss next week's explanation of the reopening. Finally, since the next move won't be revealed beforehand, subscribe if you want to be notified when China reopens and the market makes its move. It will be exposed by the response. Okay, that concludes today. This is solely for debate and education purposes and is based on data that is readily available to the public as well as my personal analysis of market behavior. You should base your selections on your own research, risk tolerance, and, if necessary, the counsel of a certified professional. This is not customized financial advice.